Right now, you are sitting on a mountain of financial knowledge, yet mathematically, you are likely poorer today than you were a few years ago. You understand the concept of compound interest. You know about index funds. You know you should be budgeting, investing, and building an emergency reserve. You have watched dozens of videos, saved hundreds of articles, and know more economic terminology than most people around you. Yet, your bank account balance completely fails to reflect that massive accumulation of information. The gap between what you know and what you actually do is widening ruthlessly. This is not a failure of your personal intelligence or willpower. It is a mathematical paradox, deliberately engineered by a financial system that profits immensely from your paralysis. Today, we are going to decode this entire picture using real numbers, peel back the hidden data that financial institutions never want you to realize, and establish a mathematical defense system based on logic rather than emotion. To understand why you know so much but implement so little, we must look at the structural root causes of the modern economy. Ever since fiat currency was decoupled from the gold standard, a systemic domino effect was triggered. Hidden inflation and the stagnation of real wages have forced ordinary workers to shoulder the risks of institutional investors just to protect their baseline purchasing power. The financial industry responded by creating an illusion of control. They flood the market with gamified trading apps and superficial financial content to make you feel like you are making progress. But in reality, they are extracting your most valuable resources, your attention and your willpower. When overloaded with information, the human brain enters a state of decision paralysis. And in an economy strictly designed to stimulate consumption, that paralysis defaults to instinctual spending. Corporations do not want you to possess true financial capability. They only want you to be entertained by financial concepts. Real financial literacy is not the amount of information stored in your head. It is automated behavior embedded into your daily life. The good news is you do not need a massive lifestyle overhaul. You only need micro habits, mathematically backed defensive actions that you set up once and allow to compound automatically over time. The first action to break out of this exploitative structure is to completely alter your valuation lens by calculating your true hourly rate. Most people only know their nominal salary. Let us run the math. Someone earning $60,000 a year, working 40 hours a week for 50 weeks, appears to be making $30 an hour. But that number ignores the brutal reality of the labor structure. Add in the commute time, say 40 minutes a day, dictated by urban sprawl. Add the unpaid preparation time. Add the mandatory unpaid lunch hour at the office. Suddenly, that 40-hour work week transforms into 50 hours of life, bound to your employment. Now factor in the taxes. That $60,000 gross drops to roughly $47,000 take-home pay. Divide $47,000 by the actual total hours sacrificed to the job, which is about 2,500 hours annually. That person's true liquid exchange rate plummets to under $19 an hour. This number changes everything. That $200 dinner is not $200, it is over 10 hours of your finite life. The $40,000 car is not $40,000, it is over 2,000 hours of labor, essentially an entire year of your life traded purely for transportation. Once you grasp this real number, a logical filter automatically activates before every spending decision, forcing you to stop buying with emotion and start evaluating with your lifespan. The next defensive strategy is to completely remove human willpower from the savings equation. Wall Street utilizes computer algorithms to automatically extract fractional pennies from every single transaction you make. You cannot fight machines with sheer human effort. You must establish an automated system to capture your wealth before the consumption engine strips it away. Behavioral psychology clearly demonstrates that money you never see in your checking account is not registered as available to spend. On payday, before you can make a single conscious decision, a predetermined percentage must automatically route directly into your investment or savings vehicles. You spend 15 minutes setting this infrastructure up once, and it operates perpetually. The mathematical target to aim for is routing at least 10% of your take-home pay. If your current cost structure does not allow that, start with 5% or even 3%. The exact percentage matters far less than the automation mechanism itself. When you eliminate the friction of manual transfers, you eliminate decision fatigue and the guilt of slipping up. Your spending will naturally conform to the remaining balance without triggering any feelings of deprivation, simply because your brain has been reprogrammed to ignore the hidden capital. The third step in your defense system is to treat your personal finances like a microcorporation through a monthly cash flow reconciliation. Corporations never operate on feelings, they operate on audited ledgers. You need to dedicate 30 minutes a month to do 3 incredibly dry but vital tasks. First, review the raw data from the previous month. No judgment, no emotion, just observe the outbound cash flows. Second, audit your core metrics. Is the emergency reserve expanding? Is toxic debt decreasing? Third, assign one and only one focal point for the following month. It could be cutting restaurant spending by 20% or ruthlessly canceling recurring subscriptions that are bleeding your accounts. Focusing on a single variable prevents your brain from being overwhelmed by the endless sea of garbage financial advice out there. 6 hours a year dedicated to this reality check yields a return on investment hundreds of times higher than thousands of hours of passive content consumption. Parallel to tracking cash flow, you must develop the ruthless ability to distinguish between assets and liabilities. The entire consumer economy is built on selling you depreciating liabilities, heavily disguised as lifestyle assets. Anything you purchase falls into exactly one of two categories. It either continuously pumps money into your pocket over time, or it continuously drains blood from your pocket over time. A car, even if bought outright with cash, remains a liability. Every single month, it erodes your wealth through insurance premiums, maintenance, and structural depreciation. Conversely, a course that equips you with a highly leveraged skill to increase your income is a true asset. It requires upfront capital but generates infinite cash flow later. You cannot survive without liabilities, but the habit here is to force your brain to accurately label every significant transaction. When you consistently ask whether this item will drain capital or generate it, your behavioral paradigm automatically shifts, rejecting things that consume wealth and desiring things that build it. To observe the full trajectory of this shift, you cannot merely look at your income, you must track your net worth quarterly. This is your true macroeconomic scoreboard. Take the total value of all your assets and subtract all your liabilities, and you get your net worth. Why track it quarterly instead of monthly? Because short-term fluctuations in financial markets are just noise. If you track it monthly, a stock market correction might trick you into believing you are getting poorer, even when your financial behavior remains excellent. Quarterly tracking filters out this macroeconomic noise and reveals the underlying trend. Statistics show that the median net worth for someone in their 40s sits suppressed at roughly $130,000 due to structural economic pressures. Seeing your net worth increase quarter over quarter provides a type of high-octane motivational fuel that no cliché financial advice can ever deliver. You are no longer blindly following rules. You are witnessing your own mathematical returns. Next, you must use corporate math against them by renegotiating your recurring bills. Telecoms, insurance companies, and subscription services rely on an economic concept known as the laziness tax. They know the customer acquisition cost is incredibly expensive compared to retaining an existing user. Yet, they quietly raise prices because statistical models prove most people will accept the default rate without ever fighting back. Break that predictive model. Once a quarter, call a service provider and demand a lower rate. Cite competitor pricing. If denied, demand to be transferred to the retention department, where the actual authority to grant discounts resides. $10 saved a month on a bill is not $10. It is $120 a year added directly to your free cash flow without being subjected to income tax. This habit trains you to refuse imposed pricing and understand that asking questions is entirely free but yields immediate cash dividends. However, playing defense is not enough to win in an era of inflation. You must go on the offensive by investing in the only asset that can never be devalued, which is your own human capital. The average person will earn several $1 million over their working lifetime. If you can increase your earning potential by just 10% through targeted skill development, that is hundreds of thousands of dollars flowing directly into your pocket. No stock market or real estate portfolio offers that kind of secure, exponential return. Allocate a fixed budget every month, no matter how small, to buy other people's time. A paid course does not just provide data, it compresses dozens of hours of someone else's trial and error into a few hours of your accelerated learning. In an economy dominated by artificial intelligence and fracturing global supply chains, your hard skills and problem-solving capabilities are the only assets the market cannot confiscate or tax. And as your cash flow begins to expand, you must deploy the ultimate weapon of financial mathematics, which is to start investing early with whatever capital you have. Look at the brutal reality of compound interest. If one person starts investing $10,000 a year at age 22, does so for exactly 10 years, and then completely stops, they will hold more wealth at retirement than someone who starts at age 32 and invests $10,000 every single year for 30 continuous years. The first person deployed $100,000 in principal. The second deployed $300,000 in principal. But time absolutely crushed that principal advantage. In investing, time is infinitely more critical than capital weight. Waiting around until you have a large sum of money is a structural error that costs you decades of compounding returns. Buy broad market index funds with ultra-low expense ratios, hold them permanently, and let the natural expansion of the global economy do the heavy lifting. To sustain this trajectory, you must shatter a societal barrier designed to keep you suppressed: the silence around money. For decades, employers and financial institutions have profited massively from information asymmetry simply because we're too afraid to discuss our finances. Statistics indicate that people who openly discuss money management strategies have a significantly higher probability of achieving financial independence. You do not need to broadcast your salary or your bank balance. Start by discussing cost structures, investment vehicles, and how to evaluate macroeconomic risks with people you implicitly trust. These conversations destroy the illusion that you are the only one struggling, while simultaneously unlocking defensive strategies you would never have formulated on your own. Ultimately, understand that the financial journey is a marathon against currency debasement. If you only stare at the finish line, you will collapse from exhaustion. You must attach small, proportionate rewards to every milestone you hit. Celebrating is not a waste of capital. It is a neuropsychological hack to pump dopamine, rewiring your brain to associate the acts of saving and investing with the joy of winning rather than the pain of ascetic sacrifice. These 10 habits do not require iron discipline or a drastic lifestyle sacrifice. They are effective because they are built upon a deep understanding of how cash flow actually moves, the mathematics of exponential growth, and the systems needed to neutralize human psychological flaws. This understanding is the definition of true financial literacy, the exact boundary separating those who struggle with money their entire lives from those who construct impenetrable financial fortresses. The gap between knowing and doing is far smaller than you imagine, and it begins with automating just one habit this week. So, in the midst of this volatile macroeconomic environment right now, what is the single biggest structural hurdle preventing you from automating your wealth? Drop your answer in the comments below, and make sure to subscribe to the channel so we can continue calculating the real numbers together.